Thank you so much, ladies and gentlemen, and welcome again to our financial intelligence episodes. Now, there are three reasons why you are going to join a money market fund or why you are going to invest in money market funds. And the first reason why you are going to invest in money market funds is for passive income is for passive income. All right. The first reason is for passive income. The second reason why you are going to invest in money market funds as an investor is for the purpose of security. Security, and I'm going to explain more about security, and of course I'm going to expound more on passive income, on what I mean by passive income. The third reason why you are going to invest in a money market fund account is for savings purposes. Now, ladies and gentlemen, let's talk about passive income. Let's talk about passive income. Now, when we talk about passive income, we say that in layman's language, passive income is that particular amount that you're going to earn through minimal efforts, or amount that you have not done a lot of things so that you can be able to earn that particular amount. It's like putting 100,000 in an investment account and waking up tomorrow only to find that there is an extra 100 shillings on top. That 100 shillings that you did not work for, you just slept and found it there. That is what we call passive income. And passive income is as a result of money working for you, as a result of money working for you. Now, if you are an investor and you have a lot of millions of money, or probably you have whatever amount that you have, and you decide to put it in a money market fund account, now what you get in as an income in daily, what you get as an income daily, that is what we call a passive income, because you are not working for it. There is somebody else who is there working for you and actually paying you that particular interest that you are getting. So for the purpose of passive income, for example, if you decide to put 1 million Kenya shillings in a money market fund account, what you are going to earn is a passive income, because you have given someone money to work with that money, and in return they are going to pay you the principal plus a top-up amount that is known as interest. All right. So that is passive income. That is the first reason you're going to invest in money market fund. Now, for security purposes, imagine you are this kind of an investor and you have a lot of money, but you are wondering, where should I keep this money that it's not going to be unsafe, or in other terms, it's going to be secure. Because if you say that you're going to put this money in a bank account, that money is not secure, because we are not talking in the perspective of theft, or probably someone is going to take your money away. No, we are talking about the rate at which that money is going to lose value because you have put it in a current account. All right. Because if you put money in a current account, there is what we call inflation, and that money is going to reduce in value in terms of the buying power of that particular money. And that's why, to make sure that your money is secure, or you have just to maintain the capital value of that money, you're going to put that money in an account that is going to give you some interest, just to make sure that you have maintained its value and to make sure that it doesn't lose value. And that's why you are going to choose a money market fund account, because money market fund account is going to compound your money daily and give you a competitive return at the end of the day, and therefore ensuring the security of your money and protecting it against losing value. All right. Now, the third thing why you are going to save your money in a money market fund account is for savings purposes. Now, if you are an investor who is looking for example, if you say that I want to save money for a certain period of time, for example, 2 years or 3 years, then the amount that I will have accumulated in that particular money market fund account, I'm going to withdraw the whole amount and now see what kind of a business I can start with this particular amount. Now, that is for savings purposes, or what we call cash accumulation. Cash accumulation. All right. Now, you are doing it to accumulate cash for the purpose of opening a business in future, or for the purpose of doing some business in future. So you can do it for passive income. You just want money to work for you, and then at the end of the month, you can be able to withdraw some interest, some interest, some interest, some interest. The second one is for security. This is person who is looking for somewhere they can stash their cash, so that it may not lose value in terms of the buying power. Then savings is someone who is looking for somewhere they can put money or contribute money, for example, daily or monthly, just to make sure that at the end of the period, or the period in which they want to save the money, or until they raise the amount that they need. For example, if you want to raise 1 million Kenya shillings, you contribute until you raise 1 million Kenya shillings, then you can start the business that you need. Now, ladies and gentlemen, today I want us to discuss about these 3 reasons why you are going to put your money in a money market fund account. And these 3 reasons that you put your money in a money market fund can either be long-term or short-term. Can either be long-term or short-term. Long-term goals or short-term goals. Short-term goals. Now, ladies and gentlemen, that reason that is going to make you put money in a money market fund account can either be a long-term goal or a long-term reason, or a short-term goal or a short-term reason. Now, long-term goals are considered to be even more than 10 years, but short-term goals is 1 year, 2 years and below. All right. So, ladies and gentlemen, now, before I go to this discussion of long-term and short-term goals and why you should consider putting or investing your money in a money market fund account when it comes to long-term as compared to short-term. You get what I'm saying? That you should consider investing your money in a money market fund account when it comes to long-term goals, or based on the long-term goals that you have as compared to short-term goals. And I'm going to explain you to, I'm going to give you a reason and a practical example why you should consider investing your money in a money market fund account for longer periods as a result, as compared to short periods. Now, but before I go to that explanation of long-term and short-term goals, ladies and gentlemen, I'm going to touch on something small. I'm going to touch on something small on why you should put your money again in a money market fund account. And the first is because money market fund are going to be less risky. Now, why you should put your money in a money market fund for longer periods, but not for shorter periods. Because you see, if you have a short-term goal of investing in a money market fund account, most people will say, you know, I don't think it's going to help me, because if I compound 100,000 for 1 year, it's just giving me a small amount of money, other than I could have just put this money somewhere else. Probably another investment account could have given me a competitive rate. You see, because you did not define the goal of investing your money in that money market fund account. And that's why, if you decide the reason why you're going to invest your money in a money market fund account for longer periods is, number one, is they are less risky. Why are they less risky? Now, when it comes to less risky, and this is something that I have mentioned there previously, we have talked about the aspect of regulation. We have talked about the aspect of regulation. Now, money market funds are going to be less risky because these companies or these fund managers are regulated by Capital Markets Authority. And the Capital Markets Authority is it's a government organization that is going to regulate a lot of investments that happen in Kenya, being money market funds being one of them. And these people have been given the guidelines or the rules that you're supposed to follow, just to make sure that they have protected the investors' money. So they are not just going to do things how they think or how they see them better, but there is some level of regulation, and that's why your money is always protected. Now, the second reason why they are less risky when it comes to long-term investment, number two, is what we call segregation of funds. Segregation of funds, right? Now, when you talk about segregation of funds, is where the fund managers are going to separate investors' money with their own money. For example, a fund manager can undertake a lot of investments. For example, real estates and other corporate bonds and so on and so on, and money market fund. Now, they are not going to mix the money for their own personal businesses with money of the fund of the investors. So it's money to do with investors. It's separated with their own personal businesses, and therefore ensuring some transparency in their businesses. The third thing is what we call diversification. Diversification. Now, ladies and gentlemen, diversification is where the fund manager is going to distribute the investors' money in various investment sectors. And we talked about three types of diversification. We talked about um, asset-based diversification. We talked about asset-based diversification. We talked about geographical-based diversification, and so on and so on. So diversification is whereby you are going to put money in different areas of investment. For example, you can allocate some money in commercial papers. You can allocate some money in corporate bonds. You can allocate some money in government bonds, and so on and so on. All right. So diversification is another way of ensuring that your money is secure, and therefore making long-term investments when it comes to money market funds less risky. All right. So, ladies and gentlemen, these are three main reasons why, when you invest in money market funds for longer periods, when you decide to put your money there for 20, 30 years, you're not supposed to worry at all, because of the aspect of regulation, segregation of funds, and diversification. These are three things that fund managers are going to ensure that they have put in place just to make sure that the investors' money is protected. Now, the second thing why investing in money market funds for longer periods is going to be capitalized is because of competitive interest rates. Competitive interest rates. Now, ladies and gentlemen, I know you are going to dispute about this, because we have seen in recent months, we have seen the rates of money market funds going down. Today is 2nd of February 2025, and we have seen the interest of money market funds going down. ZD money market fund being one of them, going down up to 7.30%. That is even below 10%. But now someone would ask, is it that we should stop investing in money market funds, or what are we supposed to do? Now, ladies and gentlemen, that is when I want to remind you that when it comes to interest of money market funds going down in returns, you're supposed to align your goals, because if you're there for short-term goals, then it might disappoint you, because you might not get the results that you intended to get. But if you are there for long-term perspective, or if you are there for long-term reasons, then you might actually be getting what you wanted. You just need to put some more time just to cover the interest rates that has gone down. So, ladies and gentlemen, when we talk about competitive interest rates, I'm not going to compare, or I'm not going to talk about interest rates that are higher than other investments. For example, you might find that the government is going to issue treasury bonds at the rate of 14%, or they are going to open bonds that you are there before at the rate of 14%, and then money market funds are going to issue their interest rate at the rate of 11.5% or 12% net interest rates after taxation. Now, if you look at it at that perspective, you're going to see that the treasury bonds are higher in interest as compared to money market funds, which are 11 and 11 or 10% in returns. But now, when we talk about competition or competitive, we are talking about the aspect of compounding. we are talking about the aspect of compounding. Now, yes, money market funds might go down in interest, but remember there is that one aspect that will always make them unique: compounding. And when we talked about compounding, ladies and gentlemen, we said compounding in layman's language is just that the profit that was earned yesterday is going to be capitalized as part of investments, or as part of the principal investment today. The profit that was earned yesterday is going to be capitalized as part of the money to be invested today. So that is the compounding aspect, and that one is going to always make money market funds become very unique, even if they go down in interest rates. So you are going to find, if you do a practical example, which you are going to do in the next few minutes here, I want us to compound 1 million. I want us to compound 1 million in 1 year. All right. And then we are going to compound again in 10 years. See the difference. And then we are going to compare it with a treasury bond that you are going to, if you purchase a treasury bond from the government for the same 10 years, see which one is making sense, and see, actually we might just use 10 years, leave the short term, because sometimes it's not going to give us a good return. So we compound and see practically what we are talking about. All right. So, ladies and gentlemen, less risky because of regulation by Capital Markets Authority, segregation of funds, that is separation of funds by the fund managers from their own funds, and then diversification, that is allocation of funds in different sectors: treasury bonds, treasury bills. We have got commercial papers, corporate bonds, and so on and so on. Now, competitive interest rates. Now, here we are talking about the aspect of compounding. Now, ladies and gentlemen, before I wind up this particular video, you can, if you decide to, let's compound 1 million. Let's say you have 1 million Kenya shillings here. Let's say that you have 1 million Kenya shilling, and I want us to compound this for 10 good years at the interest rate of 11.5%. At the interest rate of 11.5% in a money market fund. Now, for n is equals to 10 years. All right, for 10 years. Now, we are going to compare that with a treasury bond. If you decide to buy a treasury bond of the same amount of 1 million, now for 10 years, all right? So if you decide to buy a treasury bond of the same amount for 10 years, see what is the difference, and so that you can see, when it comes to long term, how money market funds are going to be competitive as compared to even other investments. All right, so I'm going to grab my calculator here. Now, ladies and gentlemen, without talking so much, let's just do that calculation and compare. And just like the old days, we normally say that our future value is equals to amount r over that is 1 plus r over f raised to power nf. Let me write this one well. So amount 1 plus r over f raised to power nf. And remember, ladies and gentlemen, our future value is what we are looking for. Amount here is equals to 1 million. Our required rate of return here is 11.5%. And frequency of compounding is 365 days, which is equals to daily. All right. Now, ladies and gentlemen, if you substitute these figures to our formula here, our future value is equals to 1 million, then 1 plus r. Now, required rate of return. Now, if you express this one in percentage, that one is 0.115 divided by 365, then raised to power nf. That is our n here. Our n here is 10 years. 10 years times 365. 10 years times 365. Now, ladies and gentlemen, very fast, if you do this calculation with me, you are going to see that if you do this calculation with me, let's start with what is in the bracket: 0.115 divided by 365, then plus 1, then raised to power, multiply this one, 10 times 365, That one is equals to that, then multiply by 1 million. And ladies and gentlemen, you are going to get 3,157,000. 3,157,000. That is equals to, our future value is equals to 3,157,621. So ladies and gentlemen, in layman's language, what we are talking about here is that if you compound 1 million in a money market fund account without withdrawing any single coin, without withdrawing anything, at an interest rate of 11.5%. But again, I want you to quote my words, that the interest rate is not going to remain constant. Sometimes this interest rate might go down or might go up depending on the market conditions. Like for example, the interest rates have gone down due to the reduction of the interest rates of treasury bills. All right. Now, this interest rate might go down, and that's why I just decided to pick the lowest interest rate when it comes to money market funds. Like for example, a Tika money market fund is giving at 11.2345% there. Now, our future value, if you calculate now, when you have already, remember now frequency of compounding is 365 days. Now, at the end, in 10 years time, remember this was just a lump sum of 1 million, and you're contributing nothing more, nothing less. There is no amount that you have been putting in that money market fund account at any given time. It was just 1 million, and you kept quiet and you slept, and your work was just to monitor if your interest was earning and so much, and so on and so on. So at the end of the investment period of 10 years, you will be having 3.157 million Kenya shillings. Now, what if you decided to invest this amount, 1 million, in a treasury bond? To invest this amount, 1 million, in a treasury bond. Now, remember, a treasury bond is not going to give any compounding here. So we are not going to do all this. We are just going to multiply figures here. And just from the history, we have seen that the treasury bonds, the government treasury bonds, T-bonds, are going to issue at the rate of 14%. Let's take a rate of 14%. Now, 14%, and 14% is an annual rate. But remember, coupon interest rates are going to be paid twice in a year. That is, after 6 months, there is a coupon that is going to be paid to the investors. After another 6 months, there is a coupon that is going to be paid to the investor. So payments are twice in a year. Unlike money market funds, this is where you have full control of your money. If you want to withdraw your money, you can withdraw anytime. If you want to retain that amount just to compound there and multiply and invest again, it's now upon it's all dependent on you. But here, coupons are going to be paid twice in a year, ladies and gentlemen. Now, if I just multiply direct here, I say 14% times 1 million, and you can see 14% times 1 million, 0.14 times 1 million is equals to 140,000, ladies and gentlemen. 140,000. That one is a coupon of a whole year. So divide this one by 2 to get a coupon for after 6 months. That is around 70,000 after 6 months, for 6 months. Now, ladies and gentlemen, you are not interested with 70,000. What you are interested with is 140,000. Now, remember, we are doing this one for 10 years. So let's take 140,000 for 1 year, then multiply it by 10 years. And this one is going to be 1.4 million thousand. That is 1.4 million. So ladies and gentlemen, if you decide to take that 1 million to treasury bonds and do treasury bonds, it's guaranteed that after 10 million, you will have gained an interest of 1,400,000 plus now your principal. That is 1 million. So the total is 2,400,000. But in money market fund account, you will have gained a total of, remember, your principal was 1 million. So if you take 3,157,621, you less 1 million, that is pure 2.2 million, or 2,157,621. Unlike in a money market fund account, you will have 1,400,000. So ladies and gentlemen, due to the effect, or due to the reasons of compounding, or the effects of compounding, that's why you are going to see that when you compare money market funds and treasury bills, here we are going to have more amount at the end of investment period of 10 years as compared to treasury bonds because of the aspect of compounding. Because if you look at here, if you take the interest alone, of 2,157,000, 2,157,000 as 621, you less what we have here, that is 1,400,000. 400,000, you are going to be left with what? This is 2,157, 621 minus 1, 400, 400,000. So this one is 757,621. 757,621. So ladies and gentlemen, you can see at the end of the investment period of 10 years, money market fund will have more money by 621,000 just because of the effect of compounding. But remember, here you are getting your amount at the end of every 6 months. There is a coupon that you are going to be paid by the Treasury, by the Central Bank of Kenya. But here in money market fund account, even if you had another opportunity whereby you can be able to withdraw this amount and utilize it somewhere else, you can actually do that, because money market funds are very liquid. There is no lock-in period, not unless you go for those special funds and so on and so on, whereby you have like 6 months of locking your money, and so, but they are going to have a higher interest, but of course the risk is higher. So here we have liquidity, but here when it comes to liquidity, it's only guaranteed after 6 months. That is where you receive your coupon only, but not the principal. Remember, the principal is returned after the investment period has elapsed, or the maturity date has reached. So ladies and gentlemen, that is a comparison of how money market funds are good when it comes to long-term investments, and that's why you should consider money market funds. Even if the interest rates are going down, there is always time, will always be the money market funds will always beat other investments when it comes to time, because time and compounding, those are two different things that are working together just to make sure that you have received a competitive return. So ladies and gentlemen, that's the reason why you should always consider money market funds when it comes to long-term investments. That is why you should consider money market funds when it comes to a long-term investment. And I believe that I've given you the other reasons. For example, the issue of less risky. We have also looked at the liquidity, whereby if you want to withdraw your money, you can always withdraw it and do it if you have an opportunity somewhere else. Now, ladies and gentlemen, this kind of information, or this kind of practical examples, you can only find them in this particular channel. And that's why this is another reason that you should stay subscribed in this particular channel. And if you're seeing me for the first time, my name is Sir John Mweri. I'm a professional accountant with Ex-Finop Accountancy and Insurance Consultancy. And when we talk about consultancy, it's about this. You ask me a question, I answer you. You ask my opinion, then I'm going to give you my expert opinion based on the question that you have asked. So ladies and gentlemen, if you have not subscribed to this particular channel, make sure you hit the subscription bell. And after you've done that, make sure you turn on the notification bell so that anytime I upload a video like this, you are the first person to get that particular video. Again, you can share this video to your friends so that we can have a lot of people being educated. And of course, you can give me a comment on the comment section and give me a like on the same video. That's all you need to do so that we can move on with the good content and the good information that we are going to share in this particular channel. Remember, the ultimate goal is financial freedom. And we said financial freedom is not a sprint, it is a marathon. And lastly, we said financial freedom, it is not an option, it is a must. Thank you so much, ladies and gentlemen, for listening. That was my time. See you on the next.